Hello my friends, Jeff, Tax Rescue CPA. Do you owe the IRS back taxes? Do you not know what to do? This can be overwhelming, and it seems like there are an unlimited number of options out there. Well, in reality, there are only one or two options you probably have, given your financial situation, what kind of tax debt it is, and where you are in life in general. Today, what I'm going to do is I'm going to break it down and show you the 10 options. These are the major options. These are really the only choices you have with how to deal with, or in one case, how to not deal with IRS tax debt. And you'll find when I go through all these that I'm going to give you some examples so you can kind of put it into perspective of how this plays out in reality. But you're going to find that most of them don't apply. They don't fit your situation. And you're going to be left with one or two. And then it's going to be up to you to decide to make that move and deal with the IRS tax debt. Okay, first up, let's talk about the big one, the elephant in the room. This is the offer in compromise, otherwise known as OIC. And this is the one you hear about, late night TV commercials, people bragging about the deal they got from the IRS, saying, hey, you can get a deal, the IRS forgives tax debt. And it's true. This is a real resolution. It really happens for real people. What you don't sometimes hear is that it's difficult. It's a long process, and the IRS goes through an exhaustive digging into your financial details. But it does work for people. Offers get approved every day, and this could be right for you in your situation. Let me give you an example of Mike. Mike was a self-employed contractor, and he had a few good years. Unfortunately, in those years, he didn't put aside anything for taxes. He didn't make estimated payments or really plan for it. And by the time he got around to doing the taxes, he was a couple years behind, and he ended up between taxes, self-employment tax, penalties, and interest, he's got a bill of $55,000 of back taxes that he owes the IRS. Then things take a turn for the worse. He's got a few bad years in business, and he ends up closing the business. Now he's left with little to no assets. He's got debt, and he ended up taking a job where he's making barely enough to get by to provide for his wife and two kids. So Mike submits an offer to the IRS, an offer in compromise, and the IRS approves it. Again, this is after some research and a little bit of time. They usually take over a year to get approved. But the IRS approves his offer for $6,500, settling his tax debt completely. Okay, so let's go to the second option. And that one is currently not collectible, known as CNC. This is the situation where you have a tax debt, but you aren't earning enough money, you don't have an income stream sufficient to cover your basic expenses and still have money left over to pay the IRS. You can't afford even the smallest payment, and you need to get the IRS, you need to get them off your back, give you a little time to recover so you can begin making payments at some point in the future. But this being placed in currently non-collectible status will stop collections, garnishments, levies, these kinds of things from the IRS making your financial life miserable. So for an example, let's take Sarah. Sarah is a single mother of three. And after a nasty divorce and tax liabilities from joint returns that were filed with her ex-husband, she has an $18,000 tax liability. But now she's lost her job, and she can't afford to make payments and still provide for her kids. By applying for CNC status, simply calling the IRS will get this done too, by the way. She can be placed into this status, and the IRS will pause collection efforts. Now, the IRS will continue to review Sarah's financial information as they receive information about her financial life, and at some point she will have to either begin making payments if she's taken out of CNC, or she'll have to reapply or reconfirm that she's in CNC. But this gives her time to get back on her feet without the IRS watching her every move, hanging over her head, and making her financial life miserable. Option number 3, installment agreement, also called IA. An installment agreement is really the option that the vast majority of people who owe the IRS end up using to resolve their tax debt. We're talking well over 90%. This is what ends up happening. And this basically amounts to asking for a loan or payments on the loan you already got from the IRS from not paying your taxes. It's kind of a backwards way of getting a loan. You borrow the money by not paying the taxes, and then you actually make payments on it after the fact. So here's an example. You got John and Lisa. They owe $25,000 to the IRS, and this is built up over several years from a side hustle that John had that he didn't set aside money to pay for the taxes on it. By the time you get some of these side hustles with income tax and self-employment tax and state tax throws it in there, you get overwhelmed by this. So in not having the money to pay this in full, they set up an installment agreement with the IRS where they gave them time to pay this off at $300 a month. And this installment agreement can be done as easily as online or by calling the IRS and asking for it. But this allowed them to budget the payments and work their way through this tax debt over time, resolving their issue. Number 4, bankruptcy. So here's what we got here is we got a situation where by filing either Chapter 7 or Chapter 13, you may be able to get rid of tax debt through that. So this is a little bit different of a resolution. This one doesn't go directly through the IRS. You're dealing with this through a separate legal proceeding through bankruptcy. And again, this is a separate legal issue. So this is when you really want to contact and consult a legal advisor on and get the right advice on how to do this. But this comes up in a situation where you've got other debt besides the tax debt, and you need a bigger solution than just dealing with the IRS tax debt. So for example, you got David, who's a small business owner, and he'd accumulated $40,000 worth of tax debt along with other debt over the years. So he files Chapter 7 bankruptcy, and because the taxes meet the criteria, I'm not going to go into the details here, but there are specific criteria that the tax debt and your tax situation must meet in order to be included in bankruptcy. But a large portion of David's tax debt was discharged in bankruptcy along with his other debts. Okay, number 5. Innocent spouse relief. Now, are you starting to get the picture about how some of these don't fit your circumstance? This is another one that is very specific to a set of facts and circumstances and does not apply to a lot of people, but it is a viable resolution for some folks that are in this situation. What does this mean? Well, the innocent spouse relief occurs when you've got a situation where your spouse, usually a former spouse, but it could be a current spouse, has kind of done you wrong, and the IRS has applied, should I best put this, they've made you liable for the tax debt that you really had nothing to do with. You didn't receive the income, you didn't benefit from the income, and therefore you're going to make the case that you shouldn't have to pay the tax on the income. So let me give you an example. We have Emmett, and he discovered that after his divorce that his ex-wife had hidden $125,000 worth of income, and she had reported it on the tax return and had filed it without Emmett's knowledge. Okay, I know it happens. So this results in a large tax debt that is in both of their names, that the IRS considers both of them equally liable for, and then it will come after both of them equally until the tax debt is paid. So Emmett applies and makes his case for innocent spouse relief, and the IRS is convinced and grants him that. And then what happens is his name is just simply taken off that tax debt, leaving his ex-wife solely liable to pay those taxes. All right, we are up to number 6. This one's interesting because this is the default option. So if you don't do anything, you are doing something. You're choosing this one. Well, what is this one? This one's basically where you wait the 10-year clock. The IRS has 10 years to collect the debt if the clock isn't stopped for any reason, and that's a whole different video, but there are several reasons why the IRS clock can be stopped. But assuming that the clock is not stopped, the IRS has 10 years from the tax being assessed, like when you file the return, to collect the tax, okay? So one of the methods is just not pay it and wait for 10 years to occur, 10 to go by, and then the IRS can't collect it. This works a lot of times for people that end up with, they have a tax that then is assessed, but then they don't really have anything after that the IRS can grab. Maybe they have a tax and then they don't have any income or any refunds or any assets, anything the IRS can really get. Or the tax is due is small enough where the IRS doesn't get that aggressive in going after the tax. But that's the essence here, is that you have, or the IRS has 10 years to get that money from you, and then it just expires. So an example of this, we have Robert, who owes $20,000, and this was, again, kind of like our example earlier, where he had a business, but then it failed, and the income, the years where he had income in the business generated this tax liability, but then it went south, and he hasn't had any income since, and this was 8 years ago, and now he's looking at this going, well, I haven't had to pay it, or the IRS hasn't collected it and gotten aggressive in 8 years. I'm just gonna wait out the last 2 years, and sure enough, on the 10th birthday of the assessment, it goes away and it gets eliminated, forgiven, dismissed, whatever you want to call it, it's done. Okay, option number 7 is you pay the debt off in full. Obviously, this is the simplest one of all of these options, and it can be done online. You can simply go on the IRS website and pay the debt. An example of where this comes into play is you've got Jessica, who had inherited $15,000 from the death of her brother, after the death of her brother, and she used this money to pay off a tax debt that had been growing slowly year after year. By doing so, she gets rid of the debt, eliminates any further interest and penalties, can move on with her life. Okay, number 8, penalty abatement. Most likely, penalties are a large part of your tax debt. It's just how the IRS works. And there are some circumstances, usually those that are outside of your control, that can lend you having a reasonable cause basis for requesting penalty abatement. So let me give you an example. We've got Tom, who after 10 years of filing and paying his taxes on time, he was hit with $8,000 worth of penalties after he missed filing deadlines and payments due to being hospitalized from a major surgery. So he applied for first-time penalty abatement, and he had his penalties removed. Now, penalty abatement can come from either first-time abatement, like I detailed, or from reasonable cause. In this case, our example could kind of go both ways, but I'll give you a little secret. First-time abatement is a lot easier to get. Number 9, we're getting close, my friends. Number 9 is to replace SFR tax assessment. Okay, what's this all about? SFR stands for substitute for return. So what happens is if you don't file a tax return, the IRS may do it for you. And when they file this SFR return, or SFR, they will file it in the least favorable way to the tax liability outcome, okay? Basically, you're gonna owe a lot more than if you filed the return. So the way to fix this is to file the return. All right, so let's do an example. Is Maria never filed her 2016 returns. So the IRS filed an SFR and claiming that she owed $30,000, interest and penalties, all of that, 30,000 bucks. So she said, well, hey, wait a minute, let me file the correct return, taking advantage of all the deductions and credits that I'm eligible for. So she does this, she files the correct return, and then it reduces her tax liability, including the interest and penalties, all the way down to $5,500, dealing with the tax debt, making it something she could afford to pay. Number 10, okay, I've saved this one for the end because it only applies to a very small percentage of folks, but let's talk about it because it is an option, and that is you dispute the tax on technical grounds. So if you believe that the IRS incorrectly assessed this tax on you, you can dispute it. There's all kinds of reasons for this and different scenarios that this may be an option under, but let's do an example. So we got Kevin, and he received a tax bill for $10,000 after an IRS audit. Well, after he reviewed that notice and found that the calculations were simply wrong. So he filed an appeal, presented the correct information or the correcting information to the IRS, and reduced his tax bill by 80%. That's how you get it done. Okay, so there are your 10 options. Which one is right for you? And that may be the case where there's only one that could possibly work for you. Maybe two, probably not three, but you're really looking at one or two. So eliminate the ones that you're sort of like, no, Jeff, those don't work for me at all. I'm not gonna do this. This is the one, that's the one that will work in my situation and help me to deal with this IRS debt. If you need any help working through these issues, let me know. Drop a comment in the comment box below, or here's an invitation to get a free tax review. Now go deal with your IRS tax debt. Who's doing your taxes?